Interest costs incurred in financing the construction of a long-term asset can be capitalized and deferred. In order to determine whether or not interest will be capitalized for a particular project, we have to go through a number of steps. The first is to figure out if the asset actually qualifies for this treatment. In order to qualify, the asset must require a period of time to get ready for its use, and the asset may be for a company's own use, or it could be intended for sale or lease. We're going to be looking at this KC Corporation example. The special equipment qualifies because it requires a period of time to get ready and it will be used in the company's operations. The second step is to determine the capitalization period. The capitalization period begins when the expenditures for the asset have been made, activities for readying the asset are in progress, and interest costs are being incurred. So capitalization will continue as long as these three are present. It will end when the asset is substantially complete and ready for use. In our case, the period will run from January 1 through December 31st because expenditures are being made and the interest costs are being incurred while construction is taking place. The heart of the calculation is in step 3 and step 4. In step 3, we determine the weighted average expenditures. First, we drop in the actual expenditures. So I pulled these from this problem, the actual expenditures, and dropped them into here. The capitalization period determines how much of that expenditure will be weighted in our ending calculation. The first expenditure took place on January 1st, so basically 12 months out of 12 months applies. The expenditure was outstanding for 12 months. In the second case, because the expenditure was made on April 30th, January, February, March, and April, 4 months weren't applicable. So you can see I took 8 and divided by 12. The next one, the expenditure took place on November 1st, so I've got 2 months out of 12. And the last one, because the expenditure took place on December 31st, there's no effect in that year. The last column is determined by just taking the actual expenditures and multiplying by this capitalization period. Then we simply add these up and we get 250,000. That's the only number that we're going to use from this table in this lower segment. So 250,000 of weighted average expenditures. We'll drop that in a little bit. Step 4, we're going to compute the actual and avoidable interest. So first we'll compute the actual and then we're going to compare it to what we come up with for the avoidable. For actual, we're going to look at the specific debt. In our problem, it mentions that we borrowed 200,000 for this specific purpose. So I'm going to drop in the 200,000 of debt. The applicable interest rate is 12%, and I'll take the debt times that 12%. Then we've got some general debt. 2 pieces of general debt. I've got 500,000 and I've got 300,000. 500,000 is at 14% and 300,000 is at 10%. So I'm going to bring that across and I've got 70,000 and 30,000. My total of general debt is going to be 100,000. Now what I'd like to do is get a weighted average interest rate on the general debt because I have a 14% loan and a 10% loan, but the 14% is weighted higher because it's going to have 500,000 of debt attached to it, and the 10% will be lighter because it's only got 300,000 attached to it compared to the 500,000. So to get that weighted average interest rate, I'm going to take the total interest and I'm going to divide that by the total debt. The total debt is going to be 800,000. So the weighted average interest rate is 13%. If we bring that out a decimal point, it's going to look like 12.5%. Okay, now we're down to avoidable interest. Avoidable interest is based upon the weighted average expenditures. So that's going to be our total. The 250,000 needs to be our total of our accumulated expenditures. Then what we do is take that 250 and we first look at specific debt. So the 250, we can get 200,000 out of our specific debt. We always start with our specific debt. We've used 200 of the 250. The 50,000 then is going to come out of the general debt. So again, we start with the 250. The 250 is dropped down directly into the schedule. We start with the specific debt. Let's assume the specific debt was 300,000. Then that whole 250 could be taken out of the 300,000 and we would have 250 of specific debt and nothing for general debt. Okay, the interest rate that applies to the specific debt is the 12%. The interest rate that applies to the 50,000 is our weighted average interest rate on the general debt. To calculate the voidable interest, we're going to take the interest rate and multiply that by the accumulated expenditure, and we'll get a total of $30,250. In our last step, we're going to compare the avoidable interest and the actual interest. The avoidable interest is the $30,250. The actual interest is the total of the $24,000 plus the $100,000. We want to capitalize the lesser of the two. Obviously, the lesser of the two is the $30,250. The $30,250 is going to be capitalized as equipment, and assuming that we already expensed that interest as we paid it, we would take it out of interest expense, so we would credit interest expense for that $30,250. So this is our final entry. To arrive at that, we had to first figure out if the asset qualified for interest capitalization and determine the capitalization period. We computed the weighted average expenditures based on the time period that the actual expenditures were outstanding. That $250 dropped down below, and it helped us determine the avoidable interest. We did calculations to come up with the actual interest for the year and the avoidable interest for the year. We looked at those two numbers and capitalized the lesser of the two. We put that amount directly into the equipment and credited interest expense because we assumed that that amount was originally expensed when paid.